though. You just
Yeah,
have to close that window so it doesn't echo.
noted. All right. We are back. We're trying this again. Okay, the devil is a liar. Welcome, 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 guys. My name is Keanna Hinds. I am the CEO of the Toni Foundation, Inc., and we are here with special guest, Miss Mia James. This is our part two of finances and funerals, or funerals and finances, where we are diving deep on all things life insurance, benefits, how to prepare for the future, and legacy building. So, my name is Keanna. Like I stated, I am a registered nurse. I'm a mom, and I'm also a grief coach. Started the Toni Rose Foundation back in 2019 after losing my mom tragically. And I started this YouTube series just to share a lot of education and also get connections to some really dope people that have a lot of information to share. So, without further ado, Mia, you want to introduce yourself and share something about yourself?
Absolutely. Well, first of all, thank you so much for having me on, Kiana. I really, truly appreciate you as usual because you are awesome and you're doing great work.
Thank you.
Um, you're most welcome, my love. So, who is Mia James? So I am a financial wellness coach and I help women to see the financial opportunities they're missing and to simplify their decisions so that it feels easy, especially when it comes to money, because in things like insurance or any complex financial concept, because sometimes we have all these benefits, we have all these policies and these accounts, and it's like, what are these things doing for us,
Yeah.
right? And so I want to help women to be at ease with their finances and really just living their dreams, because guess what, our dreams take money.
Yeah, it does. And that's something that we need to get in order to have them to succeed. So, before we even jump into this, I want to give a disclaimer. So, this conversation is for educational purposes only. Okay. Every family's financial situation and insurance policy is different. Before purchasing, changing, borrowing from, or canceling a policy, speak directly with a licensed insurance professional, and when necessary, a tax or legal professional. All right. So, without further ado, so during part one, we talked about the importance of life insurance, introduced the term life insurance, right, versus permanent life insurance. And tonight we're going a little bit deeper. I want to talk about children's life insurance. Like, we don't ever talk about kids getting their own policy because we never, who wants to think about the inevitable, right? But there's ways that life insurance can support generational wealth, and that may be one of the pathways to it. So, what does it mean to borrow against a policy? All those few myths that we want to really debunk, we're going to talk about today. So, term life insurance. Term insurance provides coverage to a specific amount of time, right? So, it's like 10 years, 20, and up to 30 is the most, Mia.
Yep, you got it.
Sometimes, from what I know, it is generally less expensive in the beginning.
Hmm.
Um, it does not usually build cash value. Okay. The death benefit is paid when the insured person dies while the policy is active. Okay. You want to explain what that means, Mia?
Absolutely.
That
So
had me a little bit like, what?
sure. So basically it just means that someone has to pass away in order for the benefit to be paid out.
Okay.
So there's no living, well, in some cases there's no living benefits. There's only a death benefit. Um,
Mm,
and you have to make sure that your premiums are paid up to date, because if the policy has lapsed, no matter how long you've been paying into a term policy, the beneficiaries will not receive anything.
yeah.
So it has to be active and in good standing.
Yeah, we touched on that a bit on part one, just the importance of not seeing, a life insurance payment, monthly payment as a bill, but more so an investment, and how important it really is to actually keep on track of. Okay. Um, it may be useful when someone needs a large amount of protection during a particular period, such as while raising children, right? Paying a mortgage, replacing income, preparing for college.
Yep.
Some term policies can be converted to permanent without new proof of good health, but that depends on the policy's conversion rules. So every policy is different. Okay, so that was a little synopsis of term. Now we're gonna get into permanent. Me, I'm doing okay so far, right?
You're doing a great job, girl.
Girl, I still got questions though.
That's okay.
So permanent insurance is intended to remain active for the insured person's lifetime. So it's no cutoff like term has, um, as long as the required premium are continued to be paid. Okay, you can't stop paying. Premiums are higher than term insurance. It is what it is. Whole life premiums are just going to be higher. It can build cash value over time. Premiums are typically fixed, meaning they can't be changed. Right, that's it. And the policyholder may eventually be able to access part of the cash value through a withdrawal, surrender, or policy loan. Okay.
Oh, can I? One thing with the premiums, you can have flexible premiums on a permanent policy.
Oh, okay, that's good to know. What would be the basis around that? Like,
So
budget?
you would no, it just you just have to have a policy that allows for a flexible premium. Um,
But they do exist.
yeah, they do exist.
Okay.
And people will use that if, for example, say they lost their job, right?
Okay.
And they needed to skip a couple of payments, they could, possibly do so because it depends on what your cash value is at the
Right.
time.
You have it in there. You could do
Mhm.
that. Okay,
Yeah.
that's good to know.
Hmm.
That is very good to know. Um, and last but not least, the death benefit may be paid regardless of when the insured dies. And when the insured dies, provided the policy remains active. So once that policy is active, it doesn't matter what age that person dies, it will be paid out to you. Okay.
Yes, ma'am.
So, can someone have both term and permanent life insurance at the same time?
Absolutely. Yes.
Usually recommended, right?
I recommend it quite a bit to some of my clients, especially if they, like you said initially, if you need a large amount, but having that entire amount, like most families need 1.5 million
Mm-hmm.
or more.
Mm-hmm.
And 1.5 million in permanent coverage, depending on when you start the coverage, can be like over $1,000 a month.
Yep.
And so if you're not in a place where that's doable right now, you can do, I call it a hybrid method, where you do some term for things that eventually will either be paid down, like a mortgage, or like you said, a child's education. The children eventually grow up.
Mm-hmm.
I would do term for something like that.
Okay. It's good to know. Um, I guess who may benefit the most from term coverage? I think you sort of broke that down. So it sounds like parents maybe might be a little bit
Oh yeah, for sure. Yeah.
parents.
So I don't, like, for me, I don't have kids, so all my coverage is permanent because um I don't, it's enough so my mortgage can get paid off, and then I can you know, I can be cremated and then still leave an inheritance. So how I look at it is, if you have to split it, term is mortgage and education, and then permanent is like any inheritance, any funeral expenses. Um, and if you do have children, young children especially, or a spouse that depends on your income, a certain number of years of income, if you were to pass away prematurely.
Okay. It's good to know. What does convertible term insurance mean? I always
Sure.
think of a car.
I know, right? So it just means that you have a certain period in which you can convert that term insurance into permanent insurance without needing a medical exam.
Okay.
That's all I mean. So let's say you have a 30-year term. They may let you convert either all or a portion of it in the first 10 years of that policy, or you might be able to convert all the way until the 30 years is up. So it just depends on the terms of the contract.
Okay.
But that's what it means. It just allows you to convert into a permanent policy without having to go through a medical.
What happens when a term policy expires? I was going to ask this earlier.
Oh, goody. Okay, so I actually opened up my Illustrator, so I hope I can nerd out for a second.
Okay.
So in Illustrator, this is how how much something costs, okay, with
Okay.
insurance. So that's why I had it open. So essentially, what is going to happen is it's going to get extremely expensive. So most people end up not having coverage because they cannot afford it. once they get that age. So I'm going to take this is a 38-year-old, right? Let's say that they get a 30-year term. So I'm going to tell you what that is looking like right now, how much it's going to cost. Okay. So we're going to do 30 years. And let's just say that's $500,000 for 30 years on a 38-year-old man. So males actually cost more than females. So that's important to know. So on a monthly basis for a 38-year-old, 37-year-old healthy male, it would be like $39.95 a month for $500,000 in coverage, right? Not bad, right? 40 bucks, that's really doable. Now here's the catch. So now he's doing good. He's paying $479 a year for 30 years. When year 31 comes, he is now paying $13,061 a year. And so let me break that down monthly.
What's that monthly?
$1,088.42.
Oh, that's crazy.
That's what happens with the term. And people are caught off guard. Like if you're 65 years old and you're on a fixed income, then you're not trying to spend $1,000 a month for $500,000 in coverage. Not that you don't need the coverage, but you might not necessarily have the funds to do that.
Yeah. That's unfortunate. This is why it's really important to have both.
Yeah.
So, I mean, besides the fact of us, like, say we get there, okay, obviously I'm now 30, I'm 31 or whatever, 30 years later, 31 years later, I can't afford that $1,000 coverage. That's it. Whatever I just, put the money I spent in the last 30 years, it just null and void. It's just
pretty much unless you get a return of premium term, which is going to cost more than this because they're going to return the premium. But yeah, pretty much it's like car insurance, right? We have car insurance, but hey, Faith, but we hope that we never use our car insurance. So that's what kind of term is. Now, there are some term policies that have living benefits like terminal illness, critical illness, and chronic illness, which allows you to accelerate your death benefit if you have one of those types of illnesses. So, but other than that, it's just the death benefit.
Interesting. Very interesting. Wow.
And we don't know when we're going to pass away. So term policies only pay out 1%, about 1%.
Right. And I can imagine how much they make selling them. And they don't, I feel like that was my first time I ever heard that. And I've spoken to so many life insurance people. And I don't think I've ever heard that. Like, we only pay out about 1%. Nope. But
I tell the truth.
Yeah, it makes sense though. It makes sense.
I just tell the truth straight up. Let me let you make an informed decision.
Yeah, from it. I appreciate it. So what should someone ask before replacing an existing policy? What are the key takeaways?
So I would always say start with your goals. What are your goals of the policy? That's where I start. Is it maximum death benefit? Are you trying to leave an inheritance? Are you looking for cash value? Like everyone has different goals for their policy. Then after that, I would also look to make sure that the premiums are affordable. So the thing is, like, when people lapse policies, it's harder to get a policy again. So really one of my big missions is for people to actually see the value in life insurance. Like I was just talking to someone just a few minutes ago and I was just like, there's no way, like, for example, I was like, so if you pay $168,000 in premiums over your lifetime, right? If you put $168,000 in the bank, there's no way that your beneficiaries are going to come out with $500,000.
Right.
Like they would with a life insurance. So the return on investment, and it's not an investment, it's an insurance product. So I do want to make that distinction. But in terms of return, you're going to get far more, or your beneficiaries at least are going to get far more on the back end than the dollar for dollar that you put in, if that makes sense.
Yeah, it does.
Because people are like, oh, I need to save money, let me cut my insurance, but not understanding
in the long term you're going to end up paying more.
Yeah, or somebody gonna have to come out of pocket for your funeral. Like the one thing in life we know with 100% certainty is that we're all gonna pass away unless the rapture comes. So that I should
Mhm.
probably, but you know what I'm saying? Like it is a guarantee that more than likely you're gonna have to have either a cremation or a funeral or something.
Right. Okay. So basically, one policy is not automatically better than the other. It really
Right.
just depends on your goals, your
Mhm.
budget, how long you need the coverage for, and whether you want
Right.
a policy that builds cash value. So that's
Yep.
the synopsis for the most part. Okay.
Hmm.
Now, this is a good one I wanted to get into. When should you get life insurance for a child? Right. So there's no single perfect age for every family. Parents can explore coverage when their child is young, but the decision is based on the family's overall protection needs at the end of the day, budget, and the specific policy being offered. So before purchasing, parents should understand whether they are considering, and these terms will be explained because I had to look them up, a children's term rider, right, attached to a parent's policy, a standalone permanent policy on the child, right? A policy that builds cash value, and a rider that may later be converted into a permanent insurance.
Hmm.
Tell me what's a children's term rider?
Sure. So you actually defined it. That's what it is. It's a rider. It's probably like 15, $20,000 that's attached to the
It's
parents'
just
life
something
insurance.
that's attached onto your parents'
To the
policy. So
parents'
when
policy.
they die, when the mom or dad passes away, the child will get this on their own, or they continue to carry that on.
Not necessarily.
Okay.
Some term riders is think of it as a term for a child. So once a child is not a child anymore, then it goes away.
Oh my gosh, that's
Yeah.
horrible. This is
I actually don't, and I don't sell children term riders. I was like, get your child their own policy because if you get it, you can get a child a policy as soon as they have a social security number, which is like
right.
15 days old,
Yeah.
right? And get them their own policy. They'll just have it for the rest of their life. And then at some point, you can turn over ownership over to the child.
Right.
Then you don't have to worry about future insurability. You know, God forbid, like those. Oh, I'm getting goosebumps thinking about it. Those St. Jude commercials like break my heart. You know
Mhm.
what I mean? And it just seeing a child suffer, but you just don't know. Like life is so unpredictable. And to me, like life insurance will it just helps with risk, right? Any insurance, not I'm sorry, not just life insurance, is to take the risk off of your assets and put it onto the insurance company's assets.
Mhm. That makes sense. And obviously, the standalone permanent policy is the insurance policy from that they have on their own. Usually, that's a whole life. I'm assuming, or there's different types for kids.
Yeah, permanent.
Okay.
Because there's different types of permanent coverage. Whole life is a type of permanent.
Okay, I wanted to. I'll get into that too. How many different types are there in whole life? Because I mean, in a permanent. Because I was always the impression that they were used interchangeably. So,
Yeah, most people think so for sure.
hmm so what are some potential benefits of opening up a policy for your child, Mia?
So definitely, you don't have to worry about them being insurable in the future. Because again, if they, God forbid, they get a childhood illness, I've had a child declined because of health.
Really?
Oh yeah, yeah.
Yeah.
If the child is not healthy, because insurance, everyone cannot get insurance.
Right.
It's not guaranteed.
Hmm.
So you have to see if you're going to be approved. The other thing, you have it is definitely lower premiums, right? You can start, $25, $50 a month. Now, I work with a lot of parents that put in a lot more than that because if you do a permanent policy, you can actually pull money out when the child gets ready to go to college or purchase a home or start a business. You could pull the money tax free out of their life insurance policy. And I'm an investor,
Hmm.
and you can obviously have investments for your child. I definitely 10 out of 10 recommend that. But
Hmm.
if you sell assets for them to go to college or whatever have you, you may be subject to capital gains taxes.
Yeah.
But if you pull it out of the life insurance policy, you don't even have to worry about taxes. So I'm just saying, there's other ways. Like a lot of people are like, oh, some people think life insurance is a scam, but I mean, I've used it. many ways, withdrawals, loans, all sorts of
Mhm.
things, and it's
Yeah,
been
you just gotta be educated about it. That's
yeah.
all, and informed.
Mm-hmm. Yep. So those are the things. Just future insurability, definitely lower premiums, and that cash value because again, let's say you set up a Roth for your child.
Hmm.
That is a retirement account. Any account that has the word retirement in it is
Can't
meant for retirement. So if you need to touch it before 59 and a half, in some instances there's penalties, right?
There's always a penalty.
There's always a penalty. Well, we don't need penalties. There's other ways we can have access to our monies because it is your money
Yeah.
without penalties and taxes.
Okay. That's fair. That makes sense. A child's policy can create an opportunity to teach them about insurance, beneficiaries, savings, protection, and family planning as they get older. It's definitely a conversation starter. Just to explain to them what you have and what you can gain from this, as long as they're able to understand it. I don't think you should share it with a 5-year-old. Like, I'm a millionaire. No, you're not.
My niece, she was so excited because I told her I was going to set her up. She's my intern. She was like,
Oh,
I'm going to get a retirement account. And I said,
she
yeah.
ready. She ready to cash out. Children don't usually have income they need replacing. Because of that, families should also discuss whether the adults who financially support the child have adequate coverage.
Yeah.
Okay, so it can't be, let me give Sally, the daughter, the policy, and you don't have anything going on for yourself. It should be a whole continuing of coverage for everybody. Um,
Absolutely. And in some cases, if the parent doesn't have sufficient life insurance, the child won't be approved.
yeah, and that makes sense, right? 'Cause
Hmm.
what are we doing here? A children's policy should not automatically be presented as the best college savings or investment option. Parents should compare its projected cash value, fees, and guarantees with other savings and investment choices too. But it is an option. So, all
Hmm.
right. You stated it already. So, how young can a child be when coverage starts? As soon as they get a social security number, right? So that's at
Hmm.
15 days old. Okay.
Hmm. Yep.
We talked about the difference between a child rider, right, and a permanent whole life, a permanent policy, sorry. And does every children's policy build cash value?
I'm not a term writer, no.
Okay, terms don't.
Only
Only the
permanent.
permanent.
Hmm.
And the child takes ownership at 18 or 21, or it depends on the
It,
policy.
it depends on the owner. No, the owner decides.
Really?
So the parent decides because, if somebody's 18, they may not be financially stable to pay
Okay.
the premium. So most parents, I would assume, I haven't had any clients change ownership yet. And I do have some people that have adult
Okay.
children, but they haven't changed ownership yet.
Okay. That's fair. What happens when a child is no longer eligible for the rider?
So it depends on the company, but in most instances it just fades off of the policy.
Okay. All right. So when we discuss children's life insurance, we're not putting a price on a child's life. Okay, that's not beginning care. We're discussing protection, future insurability, and how families can prepare for situations they hope never happen. So, how can life insurance support generational wealth? Yay! Okay. Yeah, you
Yeah.
want to take it away?
Sure. So, essentially, I mean, you kind of hit the nail on the head. Life insurance is not going to automatically create generational wealth because the policy, it has to be designed properly. That's number one. So something you mentioned earlier about like fees and things of that nature, making sure you pay enough into the policy. This is more on the permanent side because again, with term is very unpredictable as to whether or not a payout will happen. Like we just don't know because we don't know when you're going to pass away. Um, I also recommend reviewing your beneficiaries on all your accounts, life insurance, investments, and etc., and making sure you review those annually because there are instances where the person who's the beneficiary is deceased,
Mm,
and so that can be held up if you don't have a trust and now it has to go through probate and figure out who's supposed to get this money. That's important too, making sure your beneficiary, excuse me, our name properly. And then it's also important to think about estate planning, because you can use your life insurance policy. Um, you can name your trust as the beneficiary. And
Mhm.
if you end up having estate taxes, then you can actually use your life insurance to cover those estate taxes as you have those assets transferred to your beneficiaries.
Good to know.
So, a couple of ways that you can use your death benefit, or if you receive a death benefit, I should say, is income replacement. So this is crucial for anyone who has people dependent on their income. Maybe it could be a spouse, a domestic partner, or children, because it's like now a whole income is missing from the household. So how, we want our loved ones to be able to stay in their home where they're comfortable, or let's say it's a stay-at-home mom, right?
Mhm.
And she hasn't worked outside of the home. Her by her spouse having a substantial life insurance policy, she can stay home with the children and continue on that lifestyle. It also can help with paying off any mortgages or debt, and that's important too, especially if there's joint debt. Funding education, again, in case of a premature death. It can also create an inheritance. So again, I talked about return.
Mhm.
You put in 100 grand, your beneficiaries get out 500 grand.
Mhm.
It's a beautiful thing, right? And
Yes,
it's
yes.
pretty much guaranteed as long as your policy is active. And then with the permanent policies, you can withdraw or you can take loans from yourself. Because let's just say you don't necessarily have the best credit and you're a business owner and you need some money, you can borrow it from yourself. There's no credit check or anything of that nature. So that's really exciting because and also there's no time frame.
To pay. Oh,
Well,
that's that too.
that let me retract that statement. You have to have money built up in there first, because I have people, they're like, okay, so I'm gonna put in $200 a month and I would like to do a loan next month. And I'm like, no, no, it
Gotta have
doesn't
it
work.
saved for a little bit. Okay.
You have to build it. You have to build, have something substantial in there. So yeah.
Okay. Noted. Noted. So generational wealth is not only about leaving millions of dollars, right? It can mean leaving enough money so our children do not have to start over. Okay. Lose the family home, take on funeral debt, or abandon their goals because the person supporting them is no longer here. Right? We've all heard the stories and we've all seen it, around us. Someone died unexpectedly. Now there's a GoFundMe up, there's raising money. We're trying to do all of the things. All of these things really can be prevented if we just take the time, meet with the right people, ask the right questions, and set things up for yourself and your family. It really does go a long way. So, all right, man. I got a few more questions. Let's see. I feel like we are saying a lot of the same things. So let's see. Okay, this is a good one. Um, should minor children be named directly as beneficiaries?
No, because they will not release funds to a minor.
Or will sit there. You may still have to go to probate court, right?
Yeah, or they're just gonna hold it until the child is 18.
Okay, good to know. What is the role of a contingent beneficiary?
The role of a contingent beneficiary is like if the primary beneficiary say that they're deceased, then now the contingent beneficiary will
Receipts.
receive the funds.
And that's the only way, right?
Mm-hmm.
Okay. I heard this before. People thinking, "Oh, that's just a second beneficiary." No, that's the
No.
he's behind. How often should beneficiaries be reviewed? Yearly, right? We talked about.
Yep. And you can have more than one beneficiary. Like I had somebody that had like 7 beneficiaries. I was like, have mercy. They
And
gonna get like $1 each. I'm just kidding.
and then still have a contingent in the background, right? So,
Mm-hmm.
okay.
Yeah, you can.
Okay. How can families make sure their loved ones know that a policy exists? Like
I
who?
think oh, sorry, go ahead.
Right? I was say who's gonna float around like, yep, just bought a 1.5 million policy, everybody.
Right. It's like I don't even want you to know I have life insurance. So
Right.
that's some people. They're like, I'm not gonna tell my family I got life
Yeah,
insurance so they can
that's
kill
hard.
me.
That's
I was
hard.
like, that's terrible. No, but in all seriousness, I'm sorry. I think finance is fun, so sometimes I do joke. But in all seriousness, I what I do for my clients after they get a policy is I send them a special email, and it has like instructions on what to say to the beneficiary. Here's how to file a claim, et cetera, et cetera. I tell them to download their policy because most of the policies are nowadays sent electronically. And if they feel comfortable, they can either give a copy of the policy to the beneficiary. Some people don't feel comfortable with that. That's fine. But what I do recommend, and this is in my book, which is called Think, Learn, and Feel Rich. In my book, I actually have a sheet at the beginning of the book, and it basically had you categorize all of your assets, and it's a one pager. So, and I recommend putting that in your legacy drawer or in a fireproof safe, and that way, whenever it's needed, when you pass away, all they have to do is get this one sheet of paper. They can see who has your life insurance, what company is under, and all they got to do is call that company and then provide your death certificate. So that's another way. You don't have to necessarily tell them, but you can have like a one pager or something. But somebody needs to know where it is.
Yeah, I think that's really, really important. That's another thing that comes up besides the GoFundMe's is usually do they have a policy? That search for it it's not it's tedious, but it's like my dad used to always tell me because he was a little bit gory. The elders used to be like, "When I die, my life insurance is right here." I'm like, "Stop telling me this! Like, this is so weird, please." But I appreciate it because I knew exactly where his stuff was when I had to get to it. So my mom, I had to search, but I did find it in the bottom drawer. So
praise God.
Right. Can a nonprofit, this is probably a question for me, but can a nonprofit or charity be named as a beneficiary?
Absolutely. Yeah. Yeah. Some people, they don't want to leave money to like an individual. So yeah, you can do charitable giving. There's also charitable trust that you can create. Yeah. So you can do a lot to give back once in your passing.
Okay. So well, this title is saying, can you borrow money from life insurance? Yes, we can. So there's policies that we make that allow us to take out loans. Okay. So cash value permanent policies may include, let me know if there's more and I'm missing any, whole life insurance. There's a universal life insurance and variable life insurance.
And there's index universal life insurance as well.
Okay. That's different from universal?
It's a little bit different because index universal life actually tracks an index. That's how the cash value grows. Like whole life, they pay dividends like stock, like in that, like to liken it. Variable life insurance is connected to sub accounts, which are actually in the market. So your death benefit can fluctuate with a variable life insurance policy. So it's not necessarily guaranteed. And final expense policies, those are the smaller ones, like 5, 10, 15, 20. They do grow cash value, but it's not going to be anything significant because the death benefit is so small.
Okay. Our final expense policies, like the policies people who would get that are over like 65, 70, say, okay. Got you. They're a little bit higher, right?
Yeah. Typically, the older you are, the higher it's going to be. Yeah. But you don't have to wait until you're old and older.
Please don't. I think that's the point of this slide.
You don't have to wait. You can have a final expense policy. Like if you're a single person, like say you're single, you don't have any kids, and you don't want that burden to be on your family, so they don't have to go do a GoFundMe or a fish fry or whatever have you. You could just get a final expense, $25,000, and there you go.
Okay. All right. And just again, one more time for the people in the back, term policies do not build cash value. All right.
Not that I've ever seen, unless it's a new thing out there. And I want to know if you know.
I don't think so. They be lying.
I haven't seen it.
Lying. A policy loan is generally taken against the accumulated cash value, so not the actual amount of the life insurance, right? But what you've
Correct.
already vested in, so what you've been paying monthly. So can't, like Mia stated earlier, you just started a policy paying 200 a month. The next month you cannot take out 10,000 because you only have 200 available.
Oh no, you don't even have
You
200.
only have 200, right? Because it has
Oh
to.
no, you don't even have
Like,
that.
girl, no.
You still have to. Okay, so how it works is you pay your premium. Now you can pay your premium annually, and you can also put a lump sum into your account when you first set it up into your policy.
Good to know.
So for my clients who do lump sums up front, they do have cash value right off the bat.
So when you pull a lump sum, do you have to pay It's up to you if you want to pay monthly, or is the monthly bill still due?
It's up to you.
Okay, so you can put it like, this is covering me for the next 6 months, or you can say I'll continue to still pay. Okay.
Well, it's annual, but yeah, it'll cover you. You can either have it cover you annually, or it can be annual plus
Plus
the
whatever I
monthly
put in.
payment. Mm-hmm.
Okay,
Yep.
let's go.
Yeah.
All right. So some facts just to repeat, to take away. The policy must first accumulate enough available cash value. So you gotta, this is you paying monthly, okay, not what you just bought, right? But what you're paying monthly. The insurance company charges interest, okay. The amount available depends on the policy.
Mm-hmm.
Repayment terms vary. An unpaid loan and interest can reduce the death benefit.
Mm-hmm.
Excessive borrowing may cause the policy to lapse. A lapse or surrender with an outstanding loan may create tax consequences when the policy has a taxable gain. You want to get into that one a little bit?
Yeah. So essentially, there is a cap on. It's called. Okay, I'm gonna try not to learn it. How can I make? I want to make it simple so everyone can understand. I was like, Mia, you're going too complex with this. Okay. When you take a loan from your policy, the assumption is that you're gonna pay it back. You don't have to though. But let's say you take the loan and you stop paying.
Okay.
The thing is, where is the money coming from to cover the minimum expenses of the policy, also known as the cost of insurance? So if you've already taken out a majority, plus you're not paying, you only leaving yourself a very small cushion to be able to keep the policy active.
Right.
So if that happens and your policy lapses and you have a loan, that will create a taxable event because
Yeah.
basically that. Let me just stop there. I'm gonna go too far.
Yourself in yeah. Okay.
Yeah. I can be a nerd sometimes.
No, I get it. But this is good to know because, like we stated earlier, this is a benefit of, borrowing from a life insurance policy versus like a retirement account, is to sort of leave that tax break. So it's good to know that, no, you cannot keep borrowing over here. This is not like, Bank Betty and it doesn't end. You have to be mindful, right, and intentional about this, because at the end of the day, this is not why we're taking out policies, right? We are doing this for legacy building. These are all like emergency type of situations. You got something to do. You're being intentional about why you need this policy. So
Exactly.
All right, and just the last thing, and I just think I just said it. Taking money out may affect how much the policy can continue supporting its life insurance cost. So that makes sense. All right.
And the other thing about the loan, like depending on what company, so like the company I have my policy with, if you after 10 years, if you take a loan, the interest is credited back to you. So it's like no interest basically. Like you pay it, but then it goes back to you.
Okay.
So and then the interest rate, like my interest rate is like 2.75%.
No, yeah.
So it's like you're not gonna get that at a bank.
Mm-hmm. Okay, that makes sense. Well, this is a good question. So let's say I'm paying 200 a month. Now the next month I want to take out 200. You're telling me, halt, you don't have 200 in there. How long normally does it take for cash value to actually start accumulating?
Oh, well. Okay, how do I want to answer that question? So it could take 3 years.
Okay.
Depending on how high your death benefit is. Okay. If you have a $25,000 death benefit and you're paying $200 a month, you'll probably have some cash value at the end of year one. But
Okay.
if you have let me see, you said 200 a month and you have a $200,000 death benefit, it's going to take some time, right? Because the higher the death benefit, the higher the cost of insurance.
Okay. Got
So, um, but you can, depending on what type of policy you have, you can actually put more funds into it. There's a ceiling though. You can't just put unlimited amount because like what some people will do is max out their 401k, max
Mm-hmm.
max that out. Then they put money into their cash value life insurance, and they can turn that into tax-free retirement money that they take out later.
Yeah, that sounds like the goal. Is a credit check required for a policy loan?
No,
Okay.
absolutely not. It's 2 sheets of paper.
Okay.
How much you want and a signature. That's it. No, that's why it's so beautiful.
That's it. What happens if the insured dies before repaying their loan?
It depends. If there's cash value still left, then it'll just reduce the death benefit. That's the short answer.
Okay. Can borrowing cause the policy to lapse? I guess if you excessively borrow, like we talked about, right?
Well, there's going to be a cap on your borrowing. You can't just keep
Okay, you can't
borrowing.
keep
There's
borrowing.
a limit. There's a cap. But
Okay.
if you borrow and you're not paying, that can cause a lapse.
Okay. And what questions should someone ask before taking out the loan? I think everybody needs to listen to this one.
So you want to know what the interest rate is. You
Mm-hmm.
want to know the repayment terms, and I mean that's pretty much
That's really
it.
it.
And
Yeah.
because it's gonna, if you don't pay it back, because you don't have to. That's another thing. Just
Mm-hmm.
know that it's gonna reduce your death benefit.
Okay. That's fair. So, yes, certain policies may provide access to money while you're living, but it isn't free money. People need to understand that interest, the effect on the death benefit, and the possibility of losing coverage exists. Okay. It's your money, but you got to be intentional about it. Okay. This is adulting. All right. So, we're going to debunk some more myths before we wrap up. Let's see. All right. The life insurance I have through my job is all I ever need. Covered.
Girl, I wish I had. I actually do have a recording. I literally just got off of a call and I told the person I moved from LA to New York, New York to Houston, and Houston back to New York. And I was like, I just want you to know how many life insurance policies I've shredded from all of the different jobs that I've had in the past. Because when you leave,
Mhm.
in most instances, not every instance, but in most, you lose that coverage. So it's best to have a standalone policy that you own, that you control, because in our generation, we don't stay at jobs for like
I
25,
know.
30 years.
I know.
So it's like you get these benefits and then you lose them. You get some more benefits, then you lose them. And it's like, if you keep doing that until you're 65 and then you look up and you're like, oh, I need some insurance, I'm getting older. Yo, it's going to cost some money.
Okay. A policy loan is free money that never has to be repaid. We just did this one, so it's not free money. I know this one already. My family will automatically know that I have life insurance. Like that's a given. I don't got to say nothing because you know what's crazy? When I was a kid, I used to think that we were born with a birth certificate and a passport. So when I
Uh-uh.
first met this is a good thing. What this is a good this is a good one. So when I met my first friend in school, and I was like going away because I went away to Stevenson like every summer, and I was telling her like, yeah, I'm going to Stevenson. And she was like, where's that? I'm like, it's in out of the country. We get on a plane. And she's like, really? I've only been to like Florida. I was like, you don't have this? She was like, no, what's that? So this is good to know because not everybody has life insurance. So your family will also know that either. And me, young Keanna, not everyone has a passport. Please go get a passport if you don't have one, though. Okay,
Please, please,
please,
and thank you.
please. Okay. Um, Once I purchase life insurance, I never have to look at it again.
Oh, I don't know, because the thing is your goals and your needs change, right?
Mhm.
I had, someone had asked me, they were like, "Hey, I need to reduce my life insurance," and I'm like, "Do you?"
Mhm. I
You know
never
what
heard
I mean?
that
But
before.
maybe,
I
you
never
know,
heard that before.
Maybe. Because again, this goes back to the value, right?
Right.
It's like if you don't see the value and then you need to cut, a lot of times the first thing people cut is
Life
insurance.
insurance,
And
yeah.
then when they need it, they don't have it.
Yeah.
So insurance is something that you gotta have before you need it, not when you need it.
It's a lot. It can be tedious because just like car insurance, right? You're paying for something with like nothing is happening yet, so I get it. But you really have to have that mindset that this is
Mhm.
preparation, this is for future, this is for safety. This is not
Exactly.
now. Okay.
Yeah.
Life insurance cannot replace the person we love. It cannot take away the pain of grief. But proper planning can reduce some of the financial confusion and pressure families experience after a death. The goal is not to create fear. The goal is to create conversations, clarity, understanding, and preparation. Okay. We want our families to inherit protection, information, and choices, not panic, not debt, and unanswered questions. Okay. Mia, thank you so much. This
You
was
are
so good. I've learned so much. I'm really hoping that we got to take away some tips from this one, part two. I know we had some technical difficulties earlier, so I'm going to obviously record this and share it on my page. I do have a call to action for everyone. All right. So, what I want everyone to do after tonight, to do three things. You're going to locate your policy, right? Check your beneficiaries and find out exactly what type of coverage you have. Don't assume, review it, see the numbers, ask questions, and make sure the people you trust know where the information can be found. All right? Start tonight, please. It's a simple task. Do it, I promise. Mia, please let the people know where they can find you, how they can get your information to connect, all those good things.
absolutely. So you can find me on beyondthebusyness.com. So you probably can see it right there in my name, next to my name, because I tried to put it, but it wouldn't allow me to. I do complimentary insurance reviews. So one thing you can do, I'm gonna put the number in the chat, but you can send me a text at 855-718-2018 and text I'm in plus your name, and then just let me know you want to do an insurance review, and I'll review your insurance for you, just to let you know, because I don't want you to end up with you know accidental death only, because if you don't die by accident, nobody gets anything.
Yeah.
So it's important to really know what you have. So I'm happy to assist. Again, beyondthebusyness.com or 855-718-2018, and I'm happy to assist you.
Will do. Thank you so much, Mia. I really appreciate it. This was awesome, informative, and a time. So have a good evening. All right.
You
And
too.
until next time.
All right. Thank you.
Bye, guys.
Bye.